Thank you for joining me. It is Wednesday, April the 12th, 2017. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber site and reports so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term, risk, and in the short term, confidence and sentiment. This month, I'd like to cover some observations I have regarding the PE expansion and contraction cycle, and I will call it a cycle. I would like to cover the areas outlined on this slide here. With the financial markets continuously rising and every dip seen as an excuse to buy, it is easy to forget that markets move in cycles. There is always a story for why the upward momentum will continue and why this time is different. But like all sine waves, which expand and contract, so do price-earnings ratios. Historically, during secular market cycles, PE expansions are to be seen and expected. Optimism for future economic and financial growth are high, and PE ratios expand to reflect that optimism. Conversely, as sentiment inevitably changes, PEs start to contract to reflect more caution and worrisome outlooks. So the question is, obviously, how do you determine when this will occur? What do you look for? Analysts determine this through a number of fashions, including the assessment of the business cycle and the credit cycle, which stages they are independently in. I have talked about both of these previously. However, another important indicator is consumer confidence and sentiment itself. Alan Greenspan, former chairman of the Federal Reserve, famously stated during a Humphrey Hawkins testimony back in the 90s that if you could determine changes in consumer sentiment in advance, it would make his job of managing the economy orders of magnitude easier. I'm paraphrasing him here, but that's what he was attempting to say, as I recall. But maybe that is not quite as difficult as he was making it out to be at the time. This is a long-term chart of consumer confidence, which I have annotated. You will notice the head and shoulders pattern that I have labeled. Major market bubbles occur at each of these tops. If you don't want to call them bubbles, as the Fed refuses to, then minimally we can call them periods of unusually high consumer confidence. You'll also notice on this chart that the long-term regression lines of both consumer confidence and the economic growth at the bottom, as represented by GDP, are steadily falling. This is extremely telling from a long-term secular standpoint. Technicians would expect patterns like the classic head and shoulders pattern to appear to signal the end or top of this long-term market pattern. I don't favor using technical analysis of economic indicators, but I make an exception to confidence and sentiment, as those technicians who follow Elliott Wave would fully appreciate why that would be. The University of Michigan Sentiment Index, as you would expect, reflects the same pattern, slightly different deviations in it, but nevertheless, same pattern. But shifting from confidence and sentiment to price to earnings ratio, I show here the historical pattern for the PE ratio. With the noticeable anomaly of the period just prior to the financial crisis, PE ratios exhibit a similar pattern and timing to those of confidence and sentiment. This very brief spike, even on the log scale of the financial crisis, still dwarfs the longer-term pattern. However, it shouldn't distract from what is secularly going on here with regards to the PE ratios. Just to put this into perspective, let's consider the well-accepted Shiller cyclically adjusted PE, or CAPE. Here we have the Shiller CAPE going back to the turn of the century, with our period since 1980 used on the previous chart shown on the right-hand side. You will notice the PE pattern changes noticeably, but still exhibits our head and shoulders pattern, shown by the black boxes, with some other very clear telltales if you look at the left-hand side. The Shiller CAPE dampens, as you would expect, the short-term spike of the financial crisis and places it in what I believe to be a correct perspective. What we've experienced since the end of the European banking crisis, when it adopted monetary policies like the ECB's expansionary balance sheet, low interest rates, and bond purchase programs like the LITRO program. They were similar in focus to the Federal Reserve's. Slightly different, but nevertheless same intent. The financial liquidity created by the central banks of the EU, US, Japan, and UK have been sufficient to explode an S&P 500 PE increase of 47% and an S&P increase itself of 33% since 2014. Meanwhile, earnings per share, as we will see, has flattened over the last 2 years with revenues falling. This chart of the Federal Reserve's liquidity supernova, up until the taper tantrum, shows how dramatic this has been in a historical context. How could it not affect PEs? But as I said earlier, it is actually the combination of central banks' actions that have driven financial markets, not just the U.S. Federal Reserve. As I have pointed out many times in previous discussions, you must remember and not forget, the central bankers are still injecting nearly $200 billion a month of financial liquidity. Not the United States, but the other central bankers at this point in time. You should ask why this is required nearly a decade now, after the 2007-2008 financial crisis. What are they not telling us? What few appreciate is despite $1.7 trillion in buybacks since this 2014 date, the earnings per share is flat. The amount of stock that has been pulled from the market is truly significant. Corporations don't buy back their stock to such a degree if they see economic growth ahead of them that will require capital to be garnered. Instead, they have overproduction, excess supply, capacity underutilization, and falling productivity growth rates. These concerns are factors that should contract PEs, not expand them, but clearly they haven't started contracting. To achieve share repurchases and dividend payouts in a yield-starved world, corporations have loaded up on debt. It isn't just the amount of debt, however, but also the duration of that debt. Little of this debt has gone into productive utilization. How long can this go on, and how long can PE stay at these levels? How long can they sustain this debt levels, and especially if interest rates were to go up, as the Federal Reserve is signaling? If we consider corporate profits before tax, we can see clearly the two eras of central bank reflationary policy. Remember, as monetary zero interest rate policies kicked in, it allowed corporations to refinance their entire balance sheets, all of their existing debt, at substantial interest payment reductions. This went straight to the bottom line. Of course, it soon ended when all that debt was quickly refinanced, and you can see it in the charts. Of course, on an after-tax basis, things weren't nearly as attractive since that debt financing had tax advantages to incent, or at least to try to incent, corporations to invest, which they did, but not into productive assets. This they did since 2014 in the area, as I mentioned, of buybacks and dividend payouts. Since the Trump election victory, the markets, as we are all well aware, have further accelerated upwards on expectation of the Trump administration delivering tax reform, fiscal stimulus, and regulatory clawback. Unfortunately, economic GDP growth estimates don't match these corporate financial expectations and market euphoria. Corporate profit expectations are built on a lot of hope and promises. Obamacare repeal and replace has shown how difficult and time-consuming legislation is to get through Congress. The delay in achieving the savings from Obamacare means the expected tax reduction bill is being forced to be slipped out because they need the savings from the Obamacare repeal and replace for aggressive tax planning or tax rebates as initially planned. And also they need it for infrastructure stimulus, which is slipping. With the fiscal debt ceiling needing to be increased when Congress returns from its Easter break, we can see further problems and restrictions being put in place to allow the Trumponomic policies to be enacted. They may come, but the market has PE at levels that suggest they've got to be imminent, and clearly they're not imminent and are slipping on almost a daily basis. Earnings are being steadily reduced by analysts, but expanding P ratios are holding markets up, at least temporarily. This kind of gap does not sustain itself for very long. Something has to give. Either earnings quickly start rising or the markets need to adjust PEs. This is perfectly normal. PEs are only one measure of valuations, however. There are obviously others. They usually tie together or resolve the divergences in the various metrics. They resolve potential differences, however, quickly and in abrupt fashion has been my experience. Let's consider some of these metrics to see if we can spot some divergences with PE expectations that will soon force corrections. Cash flow. Cash flow is required to pay debt and to assume more debt for those buybacks. It is also a measure of valuation since the price of a stock is about its future discounted free cash flows. This chart shows that the S&P 500 price to EBITDA, which stands for earnings before interest, tax, depreciation, and amortization, is presently at record levels. This is not good. The price to book ratio, another well-established metric, shows we are at another historical peak level. This is also not good. The price to revenue or sales that a corporation is making is also nearing another peak level. Not good. Looks like it's not quite at the same level as the previous peak. However, just so you don't think that the price to revenue isn't quite at this peak, consider it when you use the median price of the S&P 500 as legendary fundamentalists like John Hussman uses to assess valuations, and he's been proven to really understand valuations, and you can see how distorted it really is. I personally find the forward price earnings to the VIX ratio also instructive, where we are at a new high going back to the early 90s. The channel it operates within is being tested. Remember, option prices stem from the VIX and suggest something is currently amiss here somewhere. The ratio of equities to bond returns is approaching a 29-year high. Either the bond market or equity market have something wrong, or they both do. An adjustment here can be expected sometime in 2017 in my mind, likely sooner than later. The high yield, or what is called a junk bond ratio, is now at its highest historical value. What could possibly go wrong from here? Remember, if any of these adjust, it likely will translate into a pullback in the PE ratio. I mentioned corporate debt earlier, but it is at near all-time highs when compared to economic GDP. You will notice how closely, as you would expect, that it correlates with recessions. We are overdue and likely to see a U.S. recession in 2017 or 2018 as the Fed increases its interest rates or reduces its balance sheet, which is beginning to rumor is going to be a parallel approach. Usually, this is a strong indicator in itself. That is when the Fed starts to increase rates. Frankly, historically, the Fed often inadvertently triggers a recession. It has been shown rather conclusively that valuations in excess of a 20 PE normally lead to returns will be very poor over the next 5 to 10 years. Let's look at it the other way. The trailing 12-month returns to risk gives us another perspective. Risk is extremely high for the returns we are already receiving. I will stop here on fundamentals, as I think you get the picture. The degree of risk to a potential adjustment in PE levels is extremely high. Stepping back and looking at U.S. economic growth, we see that we have had the first period of no growth for at least 6 months since the 2008-2011 aftermath of the financial crisis. Prior to that, it was after the post-dot-com crisis and early 2000s recession. This is not a good sign. Something that I've mentioned in previous discussions, and which I have updated here, is the global credit impulse. That is the change in the change. It has now gone negative. This is also not a good sign at all for economic growth going forward in the short to intermediate term. I suspect things will go on for a while longer, with some minor scares and shallow consolidations, until a real fear takes hold that a U.S. and possibly global recession is increasingly a probability. Then, like a thief in the night, current elevated PE ratios will disappear in a heartbeat with no warnings. That's the problem. They will suddenly come down without really a lot of news because people will be rebalancing portfolios out of the fear of what they see as a recession. And because nobody's talking about it doesn't mean the fear is not growing. Remember, they will print the money to solve any and all problems until such time as no one will take the money or it is of no value, that is, the money. That day is still in the future, so take advantage of the opportunities as they currently exist. Be careful. The risk is high, but the opportunities come with a level of risk. Investing is always easier, however, when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. I think we know how the central banks and the governments will react from 30,000 feet. The actual mechanics is what you need to be very, very careful with. And that's what we lay out on a regular basis at MATA SII. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2017 turn out to be an outstanding investment year for you. Thank you for listening.